A very warm good evening to everyone. I, Geeta Devi, a practicing chartered accountant from Impal, welcome you all on a very pertinent and important topic that is IPOs for mid-sized business, the way forward, and smart investing through equity and options. Organized by the Committee on Financial Market and Investors Protection of the Institute of Chartered Accountants of India. The committee works in the area of promoting investors' protection by nurturing capacity and competency, development of members and stakeholders in the financial market. The committee have been actively working in the area of financial literacy for the development of economy through its various learning initiatives of workshops and training program. And also the committee is actively involved on the mandate of Government of India for development of domain of financial market by regularly updating and educating the potential as well as the existing investors through its various trainings. Currently, the committee is working under the chairmanship of CA Charanjot Singh Nandaji and Vice Chairman CA Kothai Srinivas. CA Charanjot Singh Nanda is a Central Council member and is a chairman of various committee, that is Digital Accounting and Assurance Board and Information Technology of South Asia Federation of Accountants, and Vice Chairman of Board of Internal Audit and Management Accounting ICAI. Sir has been a member of Quality Review Board set up by the Government of India and a member of SEBI Advisory Committee on Primary Market and Committee on Mutual Funds and represented ICI and SEBI Committee on Disclosures and Accounting Standard. Convener of the expert group constituted by Ministry of Corporate Affairs, Government of India on Investors Protection. With this, I would like to conclude my speech and invite a speaker for today, CA Sanjeev sir and CA Sanjay Kapoor. A very good evening, sir.
Good evening, ma'am.
Very good evening.
Yes, sir. Should I start or Sanjay sir?
Sure, sir. Go ahead.
Yeah, okay. Good evening, everybody. Good evening, all the participants. Good evening to the CA Institute, and thanks a lot for giving me this opportunity to speak on the topic which is very relevant today. I thank Geeta ma'am for the kind introduction, introducing the institute, the torchbearers of the institute, and the topic for the day. Let me first start with sharing my screen. This topic, before I share, actually, IPO itself is a very, very large topic, and it is impossible to do justice to such a heavy and large topic in a 1.5 hours window. But I've tried to attempt to concise the discussions to take over the pertinent points. And I will just now share the video. Of course, an IPO is almost like a, as you say, it's almost like a civil project which take months and years to complete, and it's something which takes a lot of sacrifice and a lot of time to complete successfully. So this is where we start with. Do let me know if anybody has any problem in hearing or seeing the presentation, so that I can try and amend that. And let me start. So the topic for the day is IPOs for mid-sized businesses, the way forward. I'll just go to the next slide. So why is capital required? Ultimately, an IPO will be done only if there's a requirement of capital. In very rare cases, we have, like, to give an example, Dreamfolks was one such company which did an IPO about a year back or a little more than that, where the entire issue was in OFS, an offer for sale, because there was no need for capital, and it was really monetizing some of the growth which the company had achieved over the past few years. Having said that, let me come to the reason. The businesses require capital to grow and bring their vision into reality. You need capital to grow. You need capital to convert your vision into reality. Of course, there are many forms of capital, and all of them have pros and cons. Hence, it's the first and the most important and foremost thing before you decide to go for an IPO is to have a clarity as to what kind of capital does one would like to raise. They're primarily, if we do a macro analysis, then there are primarily two kind of capital: equity and debt. Both are available in multiple forms, and of course, there can be a hybrid of debt and equity, which we call as hybrid capital. So these are the three ways really of raising capital. Moving to the next slide. Debt financing is the most common way of raising capital. Not all companies raise capital through public issuances of equity or hybrid, because the process is much simpler. It takes lesser time, and you also get the advantage of leverage, where you actually can grow your return on equity by levering your balance sheet. The risk rate is fixed. You know what you have to pay. There's certainty to what the investor is going to receive. There's a bit of a certainty. And however, this also can be raised both in a public and a private platform. In coming to forms of debt capital, we have working capital financing, which is trade finance, bank credit, commercial papers, bill discounting, etc., etc., factoring. Long-term capital, of course, is debenture, term loan, securitization. Equity financing is obviously a more complex instrument and obviously a more time-consuming instrument, because it requires a lot of a much more in-depth analysis. You can raise capital. Capital is raised by selling or issuing new shares of the company. There is no obligation to repay. So one of the advantage, quote unquote, of capital issuance, equity issuance, is that you don't have to repay. It is perpetual capital. Okay. However, if you a lot of people believe that raising equity is actually free of cost. No, raising equity is not free of cost, because cost of equity is actually much higher than the cost of debt. And as you know, classically, how do you define cost of equity? It is risk-free rate plus the market returns of equity into the beta of the industry in which you operate. So basically, it will always be more than the debt capital. Just that the way you are repaying it is not very visible. There's an expectation of a return which will be much beyond the debt return. Equity investors have a stake in the company. They have a voting right, so they can, to a certain extent, decide how the company needs to progress. Recently, you have seen a minority shareholders have become very active. We also have activist shareholders who kind of aggregate minority shareholders to vote in a particular manner. Very recently, just I think a couple of days back, we had a situation where Wokhart related party transaction was rejected by the minority shareholders. So minority shareholder activism is increasing. So it's not just we can take for granted the minority shareholders. Equity investors are compensated for risk taking, as I said, and that's the formula which we spoke about. And again, here also we can raise private and public sources. In private equity, we have seed capital, we have angel investment, we have venture capital, we have private placement, and of course, there are multiple forms in different names that you can call. Public equity, we can do an IPO, which is what the topic of the day is. We can do right issue, which is post the IPO. We can issue shares. We have FPO, which is the follow-up offer subsequent to the listing. We have QIP, and then we have preferential issue. We'll just in very short detail discuss about the private equity part of public equity part of the capital. Now coming to hybrid financing, these are very complex instruments which are a hybrid of debt and equity. Investors do get certain fixed return which is lower than the debt, but they're compensated by an expected growth in the value of the equity. So and put together, overall expectation is that the return should be somewhere between a debt instrument and an equity instrument, because that's where the risk reward balance happens. Hybrid capital can absorb losses on or conserve cash without causing a legal default. So a lot of people may want to go for a hybrid instrument. But sometimes the challenge with hybrid instrument is that the conversion, when it happens, it could lead to disputes. In the past, it has led to disputes, etc. চলে গেছে না খালি আমাদের কাছে? Am I audible? Hello?
Yes, sir, you're audible.
Oh, sorry, because we just had a shutdown here.
Yeah.
So I thought that, sorry. Okay. Sorry for that. So coming to, so as I said that there's a balance between downside protection for the bonds and the upside potential of the stock. And the form of hybrid instruments are convertible debt instrument and warrants. Generally, these warrants are attached with debt instrument. So you get an upside because these warrants get ultimately converted into equity at certain price. Now coming to this whole debate on why should one go for a public equity, because public equity is a very large process. Why not private equity? Of course, both have the pros and cons, and both have different situations in which you would be wanting to raise them. So again, the stage of business, private equity is, private capital is for an early stage high growth business, where you will need to, very important point here is, you will go to a private equity funding when you need multiple rounds of funding at short intervals, because that is something which the public market will never support. If you keep raising capital every 3 months or 6 months, it is not public capital. Public market is not your play. If you look at any of the startups like Zomato or Nykaa, they have raised capital almost every 3 months, 6 months. That's not possible in public market. So if that's the requirement, then you will basically settle for a private capital. For public capital, it has to be reasonably established, a slightly matured player, already at least have been able to demonstrate successful operations. Size of the business, again, growth stage versus mid-sized to large company. Type of capital, as I already explained, growth capital. Public, you can raise growth capital, but only for the short term, because you can't keep on going to the public market every year or every 6 months. Investor class in private capital is very sophisticated investor class. There are very limited people available, whereas in public market, a very large pool of investor. You have the general public, you have the mutual fund, you have the AIFs, you have the foreign institution. There will be hundreds of such people who will be interested. Most of them are industry agnostic, whereas many private investors are industry non-agnostic. So they basically work in certain industries and don't work in certain industries. Process is, for private equity, is less regulated. So there's not so much of documentation. It's mostly negotiation, bilateral negotiation, and they're very limited intermediary. You just need two people. You need a banker, merchant banker, and you need not an investment banker, and you need a lawyer. Whereas in public market, when we go forward, there are the plethora of intermediaries which one has to deal with you. Very, very complex process. It will really choke the time, the bandwidth of the management, etc., etc. Diligence in private capital is absolutely in depth. In public market, it is a little much lesser kind of lesser depth of diligence. Timeline is generally 6 to 9 months. Generally, in many cases, we get a term sheet. I'm not talking of repeat raising of capital, but in general, 3 to 6 months. 6 months is for a new case, but you can even do it in 2, 3 months if it's a follow-on kind of capital raising. Public capital is minimum is 12 months, and I'm not talking of the SME. I'm talking the main board. SME, you can do it much faster. Actually, 6 months, I would say, because 3 months anyway for any IPO, you need preparatory stage before even you can, start working with the bankers. So that's 12 to 24 months. Cost is less in private capital. You just pay a lawyer and you just pay one investment banker, 2 to 4%, sometimes 5%. In public capital, it is very high, but it can be very low, lower than private if the size is large. So if somebody were doing a 10,000 crore IPO, they can do it in 2-3%. But if there's somebody was doing it 100 crores IPO, it could be as high as 10%. Return expectation in private capital is very high because there is no liquidity. and liquidity comes at a cost. Okay, liquidity, non-liquid, I mean, if liquidity, lack of liquidity comes at a cost. And whereas in public market, it is high compared to debt, but it is normally relative to the markets. Investor payout is generally non-dividend in private capital, but there are some recent cases where now the private equity investors also are started demanding dividend as soon as profitability is achieved, because in most of these cases, these companies are not profitable, so there's no question of dividend, and the exit is only through another equity, somebody buying them out, or you do an IPO. So a lot of time the private capital ultimately leads to an IPO, and we've seen that in many cases, like Zomato, like Nykaa, many others, Paytm also for that matter. Return obligation in private capital can be onerous, it can be documented, whereas in public market, in fact, you cannot legally guarantee any return. So there's no question of any return. Yes, there's an expectation that you must perform better than the market. You are looking at an alpha, and generally good IPOs do give alpha, we have seen in the recent cases. Liquidity, very low liquidity, private equity, it's difficult to sell, it's a huge process. In public market, the exit is very easy. If somebody gets an share allotted in listing, in post listing, you can immediately sell, barring the lock-in shareholders, of course. Post investment monitoring is huge in private capital. In public capital, it was very less. Now the scrutiny is more. It is more passive. But yes, you have to be communicating with the investor, and we will come to that in subsequent slides. And of course, ease of fundraise, again, I said similar to initial. Future fundraise is, every private equity fundraise is not so easy. It's a little time consuming, whereas public capital, the first issuance is very elaborate, but follow up becomes very easy. So that's why they say once you become listed, it's so easy. It's like you've got a license to raise capital for future also. If you're performing well, you can do a follow up or a QIP in 1 month, 1.5 months. So that's never possible in a private equity raise. Going to the next slide. So initial public offering, I think an overview. We very quickly run through this slide. So first time issuance is called initial public offering. It turns a private company or a public company which is not widely held into a listed entity, and then a piece of the company can be held by a general public, by just a middle class human being can become a part of that. He can say that I'm an owner of this company. So someone can say that I'm the owner, a part owner of Reliance. Role of SEBI is very important in IPO. It is a completely regulated process, whereas private equity is very less regulated, other than the FEMA and all those where foreign investments is regulated, but otherwise they are less regulated. This is completely regulated by ICDR. ICDR itself has undergoing huge changes. I remember in February, there was a compilation of the ICDR regulation which came in, which compiled the changes, the amendments, and again we had another amendment in May, and now we have another new compiled ICDR regulation. So this keeps changing, and one has to be well aware of it. And then of course there are a lot of guidelines for disclosure, etc. Types of public equity, public equity issuance, as I said in the earlier slide, I'm just elaborating. IPO is the fresh issue, first time. It is the first time you get listed in a stock exchange. Right issue is when you are following up, but here you are not selecting the investors, you are just giving to the existing investor in a certain ratio shares to all the existing investors without any discrimination. Further public offer again is an FPO where you actually do an IPO, fresh IPO, where anyone who applies, very few people actually do FPOs these days. QIP is very popular, where if you want to raise intermediary capital, let's say that we got listed, of course, up to 6 months, you can't do an IPO, any issuance after the initial listing. But after 1 year, let's say you got a beautiful opportunity to acquire a company and you want to raise capital, it's a very short, simple process, of course, SEBI regulated, where institutional buyer, you can place your stock. And then preferential issue, of course, is not the preferred route, mostly because many investors don't like it, but then you actually selectively place stock to preferential buyers, but then the valuation rules are very strict for this, and there are a lot of process. We are largely going to deal in this presentation on the first block, which is the initial public offer. Coming to public offer, again, there are two options which you have. One is the SME and one is the main board IPO. Characteristic of the, and how do you decide which one do you go? So basically, SME IPO is for smaller stage. Sometimes startups, because startups can also go into IPO, early stage growth companies. Of course, main board IPO is more matured. Regulatory requirement, because these are lesser, smaller issues, and there are certain categories of investors. The minimum lot size is much larger. Okay, so you have a little relaxed regulation, whereas in the main board, because general public can apply up to 35%, in order to protect the general public, the regulations are much more stricter. Listing platform are separate for both. For SME IPO, there's a specific platform, NSE Emerge and BSE SME platform, whereas in the main board, it is NSE, BSE. Of course, other stock exchange have lost their relevance. Investor base, largely in SME IPOs, will be retail and HNI, and maybe some small institutional investor, maybe PMSs, maybe I haven't seen too many mutual funds participating. In some cases, yes, I've seen foreign institutions participating, but they are smaller ones. Whereas broader range, but in main IPO, you have the entire range who can, all retail, FIIs, mutual funds, etc., can operate. And also, obviously the size, the IPO size itself will be much smaller in SME IPO. Offering size, again, I said smaller capital. I have seen people now going up to 100 crores, but I think the sweet spot for an SME IPO would be anywhere between 25 crores to 75 crores. Whereas main IPO board, people can do above 100 crores, but it generally tends to become very expensive. So I think 150 to 200 crores is where you should really be serious. If you're raising that capital, then there's no brainer that you can go for a main board IPO. Market visibility and liquidity, obviously, is a smaller platform, lesser investors. You will have lower market visibility and liquidity, whereas main board is very highly liquid. And India stock market is one of the most efficient stock market today in the world. And in fact, BSE NSEs have the best AIs today. One of the best ways they handle the investor, insider trading, etc., very, very efficiently. Moving to the next slide. Eligibility criteria for SME IPO, very quickly. This is just theory. Less than 10 crores of paid up capital, post-issue face value. Capital can be up to 25 crores. Issuers satisfies. There are certain track record, but they are much simpler, much less onerous. Again, if you are converting into LLP, then there are certain financial requirements which are slightly different from the normal companies. Again, there is auditor certification, etc. The most important part and the most difficult part in a SME IPO is that it has to be 100% underwritten, unlike the main board IPOs, where you do book building process. Eligibility for criteria for main board. Now, we really come from the background. Now we are really moving to the main structure of the presentation, which is the main board IPO. So some of the criteria are net tangible assets have to be at least 3 crores in each of the three preceding years. Now, just to tell you that for the main board IPO, one has to reinstate their financials for at least 3 years backward plus the broken period. So if you are in September, then you will do, if you do an IPO this September, or if you file the DIP after this September, then you would, and there's a technicality, you would do September accounts and 3 years prior to that. So 23, 22, 21. And these have to be restated. If these are IGAP accounts, you have to convert that to Ind AS mandatorily. So these are mandated. Now, when you file when the time you file the DRHP, you cannot, your accounts on which the DRHP is filed cannot be more than 6 months old. So if you are filing in August, you can go with, let's say, March account, but if you are filing in October, then you have to go with the June accounts. And just to clarify, average operating profit of at least 15 crores for the preceding 3 full year. Operating profit is profit before finance cost and tax expenses, but after excluding other income. This defined by ICDR regulations. Net worth at least 1 CR in the each of the preceding full 3 years. And then in case of name change, I mean, this is just a trivia, 50% revenue has to come from the new business. Now, there are two kinds of IPO. One is price discovery through fixed price, and then there is one where conditions are not met. So what SEBI did a few years back is there were a lot of these new age companies like Paytm, Zomato, etc., which would not make profits in the near future, but they are still expected to be an IPOable company. So they came out with a new set of rules that, okay, a loss-making company can also do an IPO, but there'll be certain stringent conditions. We will have the public participation will reduce because the risk is higher. So in a normal IPO, public is 35%, HNIs are 15%, and institutional investors are 50%. Whereas in the second case, which is the 10(2), section 10(2), you have minimum 75% to be institutional investor and only 10% retail and 15% HNI. So that's where you are saying that, okay, let more risky company raise capital, but let us not expose the public for more than 10%. There's another trivia here which I would like to say is that there are companies which do not want to get into the rigor of following certain US Securities Act, which is very draconian, regulations. So they go for Regulation S of the Securities, US Securities Act, which allows you to do an issue without doing certain formalities which Securities and Exchange Board would want you to do. But in that case, you cannot market the IPO in USA, Canada, Bahrain, Jordan, Kuwait, Oman, Qatar, China, Japan, HK, and Singapore. Only institutional investors you can market. So you're really limiting your marketing to certain countries. But if your IPO is below 1,000 crores, people don't they don't bother, because today in India itself, most of the FIs are either sitting in India or Hong Kong or Singapore. So you're anyway covering most of the world. Plus, the Indian mutual funds are today the largest investor in IPOs. So even if you do not get a lot of FIIs, you will still have enough mutual funds. And you know how the SIP culture has changed the entire mutual fund industry. It's become like 5 times in 5 years kind of situation, last 10 years. So you're still fine. But still larger companies, very large IPOs they do a global roadshow, in which case, obviously, you have to follow certain regulation. And in those cases, the DRHP is actually drafted and written. As we call technically, the pen is held by the international lawyer. And it obviously is more expensive because international lawyers are very, very expensive. Major investment categories. So we have QIB, and I'm not reading this list. I think the institute will probably have a method to kind of distribute this presentation. But these are basically mutual fund, public financial institutions, foreign institutional investors, AFIs, AIFs, mutual funds, PMSs, etc., etc., etc. And then you have retail investors, which are people who cannot apply more than 2 lakhs per PAN. So this is completely tracked by PAN. If somebody tries to apply in 2 different accounts, DP, okay, one of them will get rejected definitely. I've just done a process, so we've seen so many rejections happening. And then you have non-institutional investors, which are basically called HNIs. So you have one which is small HNI, which is bids between 2 to 10. And then you have large HNIs, which is between above 10. So this is where the thing. And then you have anchor investments. So one day prior to the opening of the IPO, you allow anchor investors to bid. You receive the bids with them, and they allocate them. The advantage with the anchor investment is that you are able to showcase your IPO strength by getting good anchor investor participate If the demand is very strong, if you have good names, then it helps in your main issue, which will open the next day. An anchor investor is generally 30% of the total issue, or you can also say it is 60% of the QIB portion. So if 50% is the QIB portion, 60 of 50, which is 30%, is the anchor investor. In a very recent issue, which we handled, we got an IPO. We got a very strong, demand from the anchor investors. I mean, 8 out of 10 top mutual fund, top FIs actually bid, and based that when we launched the IPO, our QIB portion got subscribed almost 220 times plus. So that's the power of the anchor investor. So just to explain you in the trivia, anchor investor will set the pace for your IPO. If you have a great anchor investor, you will find the other institutional investors will follow, and then the HNIs follow the anchor and the QIB investors, and the general public is the last leg of follower. They will just go by what is the how much is the institutional and the HNI investing. So that's how the whole thing works. That's it's a self built marketing kind of thing. So finally, we know all the categories, etc. Who are the major? So what is the decision and why the main board? Reason to go public? Of course, capital need for growth and expansion, debt not suited. So I'm rejecting debt. Why debt is not suited? Maybe you're already high levered. Okay. Maybe you don't want to have that fixed cost in your books. Then private equity not an option, as the business is in mature stage. So you have to reject private equity. Acquire other companies which. So what happens is that if you are a publicly listed company, then your equity becomes a currency. So when you have to acquire something, instead of paying cash, you can do a share swap. But that share swap never happens in a non-listed company because that's not liquid. So you want to create a currency. You provide liquidity to existing shareholders. So if you are already a private equity funded company, you get an exit through this. You attract and retain talent employee. I know for sure that one of the companies which recently went into IPO, one of the main reasons for it was that they're a high growth company, high tech company. They wanted the IPO because they wanted to attract the best talent, because it creates a brand equity, and also you are able to then offer stock option as a part of the compensation package. So you actually lure best talent by making them part of the growth of the company in terms of monetary sense. And then of course overall it does enhance company's brand. And why main board? So my sense is, and there's no science on this number, I would say that if you are looking at a market cap which is larger than 750 crores, okay, or if you're looking at raising capital more than 100 crores, you need to look at the main board. Now the challenge is that this 100 to 200 crores, this bracket is the most difficult bracket, because neither you can raise SME, and for a main board IPO, this is too small an IPO, and you may not get best of the bankers to work for you. So that's the dilemma. So this is the area where I feel that the SME IPO has to grow to be able to cover at least up to 150 crores, but we haven't seen that happening really. 105 is the maximum. So just a thought here that this is something which the market is still evolving. Now preparing, so now we've decided to become a main board IPO company. So now the preparation. So what is it's just few things: planning and hard work. There is no, of course the company has to have, fundamentally it should be good and it should have growth prospect. But apart from that, it's planning and execution. And execution is a lot of perspiration. Okay, so you start early, don't do it alone. You can't do it alone. Companies of the size we are talking about, and we are talking about a mid-size corporate, they do not have the bandwidth to be able to drive an IPO on its own. And a lot of times I've seen companies failing because they try to do it on their own. Okay, the bankers coming in early, they will never do the heavy lifting because they are merchant bankers. They manage 15, 20 issues, 10 issues, 5 issues at a time. Okay, so they cannot come and sit in your office and help you in the IPO journey. So you need to hire an advisor, especially for these kind of companies. which are like mid-size, maybe up to 700-800 crores IPO, you would need someone like that. And then you have to also assess whether the business is ready for an IPO. Is it an IPOable company? And then assess your readiness and then launch the process. So as I said, starting early helps. Complex problem require help from both internal and external sources. Hiring the independent advisors, knowing when to go for an IPO, timing. See, you cannot time the market, but you need to time the starting of an IPO, saying that, okay, I'm ready, I've reached the critical size, and this is the best form of capital. And that's a very important decision. A detailed assessment helps in correctly predicting the time required to file an IPO. Hiring the right advisor, I think, as I said, 750,000 crores. So if the revenue is surpassing 1,000 crores, you probably may not need an advisor, or at least a full-time advisor. But otherwise, you would need one because the companies will not have bandwidth. So what does that do? Guiding whether a company is ready for an IPO. What does an advisor do? Helping in preparing a timeline, drive the IPO of the company, preparing the company's business and financial plan, helping onboard the right intermediaries, ensuring all decisions are taken in the company's best interest. This is very important. See, if you have the right advisor, of course, you have to have the right advisor. He will be working, he will be a part of the organization. So he will negotiate with the bankers, he will negotiate with the lawyers, he will negotiate with all intermediaries, and he will get the best of the people to work for you, because for him, the company's interest is the best interest, because both are one and aligned. Okay, now if you look at this is the study which was done by EY, and they said 42% had to seek internal help and extra resources, and 41 went for external. So because there's a huge bandwidth, and I do this day in, day out. I can tell you that I cannot describe I don't have words, lack of words to describe how much of effort which goes into getting an IPO through. And a lot of people start thinking that, okay, existing manpower, they will do my routine work also, and they'll also be able to do my IPO. That's when a lot of times either it fails or it gets dragged forever. Very broad, this is micro of a successful IPO. You should have a growth story, past, present, and future. Strong financial and internal controls are must. If you don't have it, if there is some gap in that, those preparatory initial stages, you have to fill those gaps. That's where the advisor also comes into place. Strong board and top, you have to create a strong board and top management. We always advise them to start early, because the board also needs to understand the business. They also want to start able to contribute. So an strong independent board, a strong top management, good governance system, strong core IPO team. Then you have to create a core IPO team. The advisor may head that team, but you need to have the management buy-in also. Industry tailwind. Industry should not be the one which is going down. It should be the one which is on the upswing. So today, to give an example, while coal is very important, but if you try to a mining company, not many mining companies have recently come for IPOs, but mining companies will still do well. But you will have to then take that extra effort to convince certain set of investors that we are doing something else which is enhancing the greenhouse effect which is creating. Just giving an example, right BRLMs to market the issue, you have to choose the right BRLM. For different size, you have different kind of merchant bankers. You have to decide which is the best fit. You may have someone who are very good in tech, who understands technology. You have to go to them. If somebody is more into industrials, you have to go to them. If you go for a very large banker for a very small IPO, even if he'll in all likelihood he will refuse it. But if he is accepting it, then the challenge will be that he may not be able to give time. That will not be his priority. So very, very important to choose the right banker, and then a good intermediate, a very strong lawyer, because the lawyer is the one who writes the DRHP. And the challenge in this whole process is that when you go out to market the IPO, you cannot write in your presentation one line which is not in the DRHP. So the DRHP has to be written very, very carefully and it has to have a flow. And I think if you compromise on a good lawyer, you will compromise on the quality of your DRHP. And of course, when you launch it, the market condition should be conducive. You have, fortunately, that 1 year window from the time you get the SEBI approval. So you have some window to time the market. So but I always say, a lot of people say that no, abhi nahi karte hain. Let's wait. The market is not good. I say don't wait. Be ready, because if you do wait for the market to be good, by the time you complete the process, which is 12 months, and when you are ready to launch, the market would have reversed. So you can't time that. You can time your process. Time your process. Do it ASAP. Be ready. You will definitely get a window within the next 12 months to be able to launch the IPO. But if you're not ready, you will just see the market peak and then go back. So that's the advice which a good advisor will always give you. Key early areas of IPO readiness, I said, identify the core company team, lenders consent. Now, this is very, very important. A very, very time consuming process sometimes. Most of the covenants, lenders covenant will have that any if the promoter is changing his stake, he has to take an approval. And a lot of times, and while IPO is good, but there is a formality. And most of the banks, these approvals goes right up to the board level, or at least the credit committee level. So it takes time. Unless you start early, very early, this can delay your IPO process. Private to public company. If you're a private company, you need to convert into public company. That process takes time. So start that early. Please appoint a company secretary if you don't have. There may not be a mandatory requirement to have a company secretary. Don't wait that, abhi, let's do it when just before we file the DRHP. No, it doesn't work like that. Because there's so many things for which you need a company secretary in the process. If you are already having shareholders, private equity shareholders, any other shareholder with whom you have SPAs and SHAs, the moment you become listed, they all become null and void. So you have to amend these existing SHAs and SPAs as per a listed entity. Then you have to, if you have ESOP, you have to convert it to compliant ESOP. A couple of things which is not in the slide. Your capital holding structure, your promoter holding structure, one should restructure that if it is inefficient. If it is tax inefficient, please do the changes, take an advice of a good tax consultant, change that, because post listing it becomes very difficult to do that, because promoters movement of shares are highly regulated. So please do it before you start the process of IPO. We always get that done. If it is good to go, if it is kosher, we don't bother. But if not kosher, then we have to make it kosher. We have to go through that process. Managing investor expectations. This is very, very important. And I'll tell you why this is important. It's important because a lot of times we ignore certain issues which are very trivia, but through experience. Now, a lot of times when you try to do an IPO, you may find that your per share value is going to 1,000-1,200 crores. Now, it is not the right, although it doesn't make any difference, but it is not the right size for a retail investor to appreciate. He may think that it's too expensive, although the valuation is more important and not the value. So we always try to keep the IPO at or below 500 rupees. So if you have to do that, you may have to split your shares, or you may have to issue bonuses. So you have to do all that to be ready to have your launch of the IPO price at around 500 or lower. Okay. The second thing is, you have to identify promoter and promoter group. This is a big challenge. We have seen in many companies IPOs getting delayed because the promoter group, there are certain regulations where you have to name the promoter group, and the promoter group is a very vast definition. If a promoter's brother-in-law also becomes a part of the promoter group, and all the companies which is under his control also become the part of the promoter group entity, and there are certain informations that has to be given in the DRSP for those companies and those individuals, and they have to also give certain undertakings. Okay, sometimes these promoter group company, they don't want to do that, so they say, no, why should I give it? I am not having any stake in the company. I have no relationship with the company. So what if I'm his brother-in-law, or so what if I'm his brother? I have nothing to do with the company. So if that challenge comes, then you have to seek an exemption from the SEBI, which is a 6 months process. So your IPO will get delayed by 6 months. So if you have a situation like that, if you're thinking you want to do an IPO, please deal with it now. Otherwise, you can say that if 18 months plus 6 months, add 6 months to your process. Board composition, please keep your board composition ready. 50% independent, retirement by rotation, women director, please get all of them. make sure that you also create the board in a manner that your committees can also be formed. I've seen a lot of places that the NRC committee, they've formed a board, they only have 2 independent directors. Now the challenge is the NRC is not sufficient. So you have to ensure that you have a board composition which has a valid board as per a listed company, and which can create valid committees as per the listed entity. Please know that the day you file the DRHP, you have to have everything, all regulation as per a listed entity. Even if you never get listed, the day you file the DRHP, you have to become like a listed company. Otherwise, you can't file a DRHP. So you have to keep everything ready. You have to have you have to have a CFO who is not just efficient, but is also presentable. You have to have a company secretary, already said. Financial reporting, again, better to move to Ind AS early rather than waiting. Please have if you don't have a peer reviewed auditor, please change them immediately, because if you do not have a peer reviewed auditor, then the whole it is literally a re-audit. So but if you have a peer reviewed, then it's a smaller kind of a change which is required. And of course, please keep track of a litigation, because and non-compliance, because that will haunt you. If your ROC returns were not filed, if your challans were not filled, you will need proof for everything. All challan copies you have to keep, because that's the part of due diligence. Otherwise, it'll all go in the risk factor, and your risk factor will look very, very ugly. And people nowadays, SEBI is so strict on risk factor. There's at least 1 month of up and down which happens only on risk factor discussion. And litigation, please keep track. The onus is on you. You cannot say that I did not receive the notice, somebody lost it. All litigations have to be updated. It's a very, very important part of the process. And this is where the experience of a good advisor comes into place. IPO process, as I said, I'm not going to take too much of time. We have about 10-15 minutes left. Conceptualization. So there is the first stage, which is the conceptualization and preparatory stage. This is even before you set up a data room. So basically, what you're doing in that period is you think, as a promoter is thinking that I want to do an IPO because I want to raise capital for certain reasons. Now, what do I do? Can I do it on my own, or I need some advisors? So that is the time you appoint an advisor, IPO advisor, who then helps you in making all the preparatory stages, including doing your long-term business planning, your financial plan, your business financial model. You make a pitch deck. That pitch deck you take to the DRS, to the bankers, because the bankers also need to be convinced that this is the IPOable company. No merchant banker wants to take up a single mandate, okay, if they believe that chances of success is only 75%. They at least want 80 to 90% success chances, then only they'll take it up. To make that, to make them believe that, you have to make the company ready for that. So you have to present it in the manner that he accepts. It's gold, but the other person should also believe that it is gold, because he's going to market the gold ultimately. Then you have DRP filing stage and regulatory approval stage. Then you have marketing price stages, and then settlement stages. All these, I think, one can read. But overall, if you look at the timeline, the initial stage can take anywhere between 3 to 6 months, depending on how ready the company is. Just to give you a small anecdote, if a company is already invested, a private equity is invested, then this will not take more than 3 months, because a lot of the regulatory aspects, a lot of the housekeeping would have already been done. But if you've never raised outside capital, I can tell you that I'm not saying that you are non-compliant, but your records will not be properly stored. They may have to be, pulled out. Maybe, you're diligently doing board meetings, but you do not have minutes properly documented, etc., etc., etc. Some of these things will also have to be done properly. And, this is where, you need to start very, very early. You cannot just say that, okay, I want to start today and tomorrow I'll open the data room and start sharing data. It doesn't work like that. A lot of people then just miss that first part. That's why I blocked it. That conceptualization preparatory stage is the most important stage. That's when you also assess whether it is an IPOable company, whether I should do private equity, whether I should go to public. All that happens here. Once you're convinced, you then kind of, hire a, merchant banker and then open the data room and start doing everything else. Again, key compliance, I mean, this is a major problem is identification of promoter group because very complicated. Okay. Here also, evaluate lock-in. Now, very important point, post-listing, at least 25% shareholding should be held by the promoters. Now, if out of that 25%, 10% is pledged, then actually your public holding will be your holding will be counted as 15% only. So you are non-compliant. Pledged shareholding is not counted as the minimum shareholding, and then there is a lot of lock-in restriction, etc. Very complicated. So all that has to be sorted out. Corporate governance have already showed issue, how to use issue proceeds. Okay, because nowadays there is a monitoring agency which has to be appointed. They monitor your usage. It's not that you have given some usage, okay, and you have raised capital, now you will start spending it for something else. That's no more allowed. So someone like a Crystal, okay, etc., will actually sit, and every quarter they will assess your usage and they will report to SEBI. So things have changed. So it's not like, you do what you want to do, because people have burned their fingers. So SEBI knows that. SEBI is there to protect the minority interest. So they will do all that. And then, of course, auditor's role is very, very critical. Also important is many of these companies will have to change the auditor. When we are going to market, it is very important which are the kind of people we are associated with. If your auditor is not identifiable by the market in general, the credibility of the issue will go down significantly. If you have, let's say, I'm not saying that it's necessary to always have the big four, not at all, but at least the top 10, 15 audit firms are must, at least for the main board IPO. Because I have seen, I can tell you, we did 150 meetings just 3 months back, and at least 25 to 30% of them asked, who is the auditor? Okay, they were one of the top auditors, of course, but all of them have not heard the name, so to explain, okay, their credentials. So that's so important. And of course, they have a huge amount of work, so they need to be competent. You cannot have an auditor who has never done an IPO. You will mess it up. So you need someone who does IPOs, whose name is recognizable, who has a strong reputation, because that adds to your credence, that adds to the authenticity of the numbers. And then, of course, group company identification and all that. So this is the other part of the compliance. I'm not going to go into these details, promoter and promoter group. It is there to read. Very, very critical, most time consuming. Your IPO can just get stuck because of promoter group for indefinite period. I will not name, but there are companies which are stuck up because this is not getting sorted out. Corporate governance, of course, I've already spoken about it. And I'm not reading this because most of it I've already spoken. Object of the issues, very, very important. I will take some time on this. Okay. What is the, so there are, you can raise capital for capex, which is growth capital. You can raise capital for raising working capital if you are expanding and growing. For working capital, you have to give the projections of the working capital built up. It is to be given, it is a part of the documented in the DRHP. Now, the flip side for it is, if a smart investor will be able to back calculate the revenue projections by that. And a lot of people do that too, and then they come to know that what is the growth. Although you're not supposed to give any forward-looking statement, but because SEBI mandates to give future, projections of working capital, if working capital is a part of your object of the issue, it's very easy for someone to find out what will be my revenue next year and next to next year. And smart investors do that, and they get comfort out of that. For the capex, very detailed. You have to get the quotation. The quotation has to be valid till the listing happens. So generally you take 6 months validity of quotation. They have to be proper quotation signed in the name of the company with the GST, etc., incorporated into it, and every line item. And that all goes into the DRHP. So it is not like, I want to raise 50 crores for putting up a new building. Okay. And just one line item. No, it will be 2 pages and every detail and all the backup quotation has to be there. Then you can raise capital for general corporate purpose, 25%. Okay, where you need not define the purpose. That's all that is required. Okay, but of course it has to be for legitimate purpose. Then you can raise capital for acquisition. Now, if it is an unnamed acquisition, you will do acquisition future. Then with GP, general corporate purpose and acquisition put together, you can do only up to 35% of the fresh issue. And then you can also raise capital for repaying of loan. And there you can, in fact, the 100% of your IPO proceeds can go to repayment of loan. So that's not an issue. So these are the things, and these are all monitored subsequently by a monitoring agency which has to be appointed. They are SEBI registered monitoring agency. Audited level, we have already spoken a bit about this. Group company disclosure, very, very detailed. Much more than what you would do in a normal company during audit. And these are certain work streams. I am skipping that. I will go to some more very important factor. What is critical for success? Management buying. A lot of times I've seen that IPO process is launched, but management is offhand. They are not involved. It needs quality time of management. Unless that is given, the IPO will never ever be successful. This is just one, kind of summary of this slide. It has to be there by. In fact, when you're doing the roadshow, you cannot do a roadshow without the promoters. Even if you have a CEO, they would want to know, meet the owner and understand his vision. It's important. If there are 150 meetings, he'll have to do 150 meetings. It's as important as that. So please take time from the time you start the IPO to end, at least initially maybe less, but later a lot of time will go into the IPO stuff. Then intermediate appointment, you have to BRLM, which is the merchant bankers before the kickoff, domestic counsel before the kickoff. Okay, international legal counsel before the kickoff. If it is not a regus, if it is a regus, if it's not a regus, you have to appoint upfront. If it is a regus, then you can appoint it at the end because the role is very limited. Auditor before the kickoff. Some of the agencies you have to, like company secretary, etc., before the kickoff. Industry report is very important because the industry report will define what will go into a DRHP, and that has to be very well handled. And that is one area where your advisor can really help you in coordinating to build one of the a very robust industrial report which goes into the DRHP, etc., etc. Registrar will happen 4 to 6 weeks before DRHP filing. Printers 1 to 2 weeks before the DRHP filing. The printer is one thing which I really feel in this age is such a waste of money. It costs about 1 crore of rupee. I don't know why we are just not doing away with it, but still there's this insistence that you need to have printed forms. So this is still going in this era. I really am still, I don't know when we will come out of it, hopefully in another 2-3 years. PR agency is required 2-3 weeks before the DRP filing, the strategy, the marketing, and they are also regulated that everything is so tight jacketed, you cannot do anything outside, this. Bankers to the issue, sponsor bank, 2 to 3 weeks before the RHP. Syndicate members, these are the ones who actually do the retail marketing of your IPO, get the bids for the retail. This is 2 to retail and HNI. This is 2 to 3 weeks. Then monitoring agency 2 to 3 weeks before RHP, but the work really starts after the RHP. And this is required for, issues which are above 100 crores. Of course, OFS, if you're doing an offer for sale where promoters are offering their own shares, then there is no role for the monitoring agency because that money, the promoter can do whatever they want to. Of course, everything legal and legitimate. Again, this is the micro was taken, macro was discussed. Now this is the micro. Essential IPO success factor. Well drafted and detailed industry report for investor to be able to understand the market play. Well drafted MD&A, management discussion and analysis in the DRHP is very, very important section where you get an opportunity to explain your numbers. And this is very, very important because some of the risk factors can be counted indirectly in the MD&A, and that's smart drafting. And there also the role of either the company CFO, if you have a very matured CFO, otherwise the company advisor's role is very, very critical. And I cannot emphasize the importance of MD&A section for the success of IPO. Business section, again, that's the story. That's what is going to, you're selling a business. So that has to be very well outlined. It has to dovetail with the industry report, etc., etc. Object of the issue should be such that it aids growth Generally, they prefer that. Okay. Selecting the appropriate KPI. Now, previously there were only specific standard KPIs, but SEBI is a very evolved regulator. They keep improving. Now they have said that okay, all industries are different, so we can bring in quantitative KPIs, etc. That is where the need of independent technical, consultant, not consultant, technical chartered engineers are required for certification. So we do get them. So if it's a manufacturing concern, we do get, so they certify the capacity, they certify things like, fastest or, most efficient and all. So that is required. Then you have to choose peers carefully. SEBI, it is a mandate for SEBI to have peer analysis. So you have to say that if you are saying that your valuation is, you want to charge 500 rupees per shares, or maybe the equity valuation is coming to XYZ, then how are your peers placed today? And that is very, and with all the KPI indicators, whether your debt equity is better than the peers, whether your ROEs are better, whether your growth is better, a lot of factors. And the choosing those peers are very important because SEBI goes back and forth on it. They sometimes reject that. No, this is not. You may say that, okay, this company looks good, let me put it in the peer. Their valuation is very high, but it has to be relevant. You can't just put anything. So you cannot force fit a peer. And SEBI challenges that. SEBI has become very, very touchy on valuation these days. Previously, SEBI was never questioning valuation, saying that it is the standard saying beauty lies in the eye of the beholder. No, I have to direct the investor to see what they should see and not what you are wanting them to see. So they do spend a lot of time on this. You'll be very surprised that 2-3 weeks will go only in this. Then validate the model by getting sense from a few. What we do generally is that we when we launch, we before the full-fledged roadshow, we talk to 2-3 investors to kind of get a sense ki, bhai, is this a good idea? Is it going to sail through? What is his expectation on valuation, etc. Once we get that comfort, when there's an alignment, then you launch the roadshow. And roadshow is really roadshow. You will be living out of your suitcase, the promoters, the bankers, and the advisor out of the suitcase for 45 days. You will always be on the road. And then deciding on whether the pre-IPO should be done. Because pre-IPO, again, gives credibility. Because if you have a good pre-IPO name, then it will help you in your IPO marketing. But when do you do the pre-IPO? You can do pre-IPO 1 year before. You can do it 6 months before. You can do it after DRP filing. You can do it just before the launch. The earlier you do, the more discount you have to give to the IPO price, because the investor is taking more risk. If you are doing it 1 year before, he will not get the same comfort that the IPO is going to happen. If you do it after the SEBI approval, then his probability goes even more. And if it happens after the UDRSP, then he is very, very confident. So, these are the things which your banker and your advisor will kind of guide you through. Again, lock-in period. I'm not getting into this, but all existing shareholders will get logged in for 6 months after the listing, other than AIF and some institutional investors who will get logged in for 6 months from the date they were allotted. Promoters, 50% of shares. Anchor investor, 50% logged in for 90 days, 50 for 30 days. And this regulation has been relaxed by SEBI recently. Then promoters, 20% is logged in for 18 months. It used to be 3 years. And remaining shares are logged in for 6 months. This is about the lock-in. It's very important that once your IPO is successful, you forget about everything and you go for sleep. No, you have to continuously engage with the investors. So that's where the investor relation comes into play. The company can do it themselves. They can hire an investor relation advisor. So first thing you do is immediately engage with the list after listing, thank the investors, and also assure them that you're going to regularly coming back with updates, not one-on-one, because that's insider, on a public platform. And then you start disclosing every quarter, communication, do road shows, meet investors. Everything is now regulated. If you're meeting an investor, you have to inform the SEBI 3 days before that. So all that have to be done. But this is a very, very important process for the continuing success of your listed space companies. What is the role of CA fraternity in the IPO process? A CA can do a lot of things, and I'm very surprised that a very few CAs are actually doing this. I would say that there's so much, one CA can do. You companies which are small size, they don't have strong CFOs. You can give CFO support services. You can review the statutory and secretarial compliances, CA, CS both put together. Conversion of financial India's audit, of course, you need statutorily. So I mean that's anyway going to happen. Mandatory certificates anyway going to happen. Additional certificate by peer reviewed independent chartered accountant, great opportunity. Financial modeling of the company, it has to be done. I personally believe CAs are the best positioned people to do it. Designing and implementing ESOP scheme and valuation. When we take advisory mandate, we do end to end all that. Okay, and of course we don't do anything which is statutory, so we don't do valuation, etc. And then valuation for the pre-IPO, etc. And there are a lot of more things. The whole guiding. If a CA is a most apt person, I would say for the role of an IPO advisor also. I can go to that extent. Being a CA myself, I can definitely vouch for that. Just these are the last couple of slides, and I think I've done my time. Mainboard IPO analysis, I'm talking of mid-sized companies, so we're talking 100 to 1,000 crores. From January 21 to August 23, there have been 79 IPOs. Pardon me if I've missed one or two here and there. The median size have been 750 crores. Number of OFSs out of the 79 has been 50. So 50 out of 79 people have done offer for sale, which means the promoters have capitalized their existing equity and taken money personally, which is nothing wrong. It's allowed. Percentage of OFS out of total issue has been 33.9%. Weighted average IPO cost is 6.6%. So IPO is not the cheapest form. Now, this will vary between 3.5% to 10-11%, depending on the size. Who are the active merchant bankers in this window in these 3 years? And you can see the list. Axis has been the most active. ICICI Security, JM, IFL, DAM, Equirus, Ambit, etc., etc. So these are the active merchant bankers. Some of the key updates, recent updates. Okay, we are ranked first for the number of IPOs and 8th for the issue proceeds, the value for YTD 23. This is just August report. No cross-border deals were recorded in this period, so there was no cross-border deal. Primary market had 6 IPOs in Q2 and a lot of IPOs. So 8 to 10 IPOs are scheduled in August and September. Okay. Pyramid Technoplast is ongoing as we speak. Aeroflex and Vishnu Prakash has started to open, is slated to open in the upcoming week. And then, of course, very recently, Concord Biotech and SBFC Finance got listed, while TVS is just completed its IPO. So listing will be about a week, 10 days from here. Bankers obviously are gung-ho. They're making good money. They're creating value for their clients. So this is where the IPO scene is. Just a case study of something which we did very recently. We onboarded the client as an IPO advisor in January 22. And this is not a marketing slide. This is just to say that what I've written earlier and what we have done is dovetailed, really dovetailed. We onboarded BRLMs in September to December. The company onboarded it. And this, so January to September was the preparatory phase. September to March was the due diligence and the filing of the documents. So in March, we filed the DRHP. Then between March to June we got the approval, so we call it approval, but basically it is the final SEBI observation letter. That means SEBI is saying, okay, these are my observations, incorporate them in the UDRHP and go ahead. So between these 3 months, it was SEBI query resolution and soft marketing of the IPO. So actually soft marketing in the sense, just to get sense on what's happening, because officially you can't market it. Then IPO launch and listing, we did it in July. We met 150 plus investors, completed pre-IPO of 50 crores, complete IPO was greater than 600 crores, very strong anchor book, record IPO closure of 90 times. This was the journey which we lived, and everything which I've spoken above all dovetails into this journey. This is all, sir, and I am done with my presentation. I'll be happy if there is a window for Q&A. Happy to answer.
Thank you, sir. Thank you.
I'm done. I'm sorry for a very lengthy presentation. I think somebody's trying to speak. I can't hear.
Hello.
Handing over back to the panel.
Just a minute, sir. Moderator is coming. I don't know. She's getting little bit.
Saturday evening.
Sure, sure. I know, sir.
Hello.
Thanks, Geeta. I've just finished my presentation. Handing over back to you, Geeta ma'am.
Now I would like to invite CA Sanjay Kapoor, sir.
Hello, good evening, everybody.
Good evening, sir.
It was great session deliberated by respected Sir CA Sanjeev on the IPOs on mid-sized businesses, way forward. It was very nice presented seminar, and we should look forward for small size IPOs, and it will be great for small mid companies so that they can come forward for the IPOs. And it was great session. Thank you, sir.
Thanks a lot for the opportunity. Really appreciate that.
Now, thanks to Central Council members CA Charanjot Singh Nanda ji and moderator CA Geeta ji and Jeevar sir and Institute of Chartered Accountants of India for giving me opportunity to speak on the today's topic, smart investing through equity and options. I want to make this webinar an interactive session so that anybody can feel free to ask questions during the session so that it can be more effective, because it is financial related session and everybody should get enriched through it. And thanks for our institute also for allowing CAs to trade in future and options, being in practice also. I am still an option learner each day, and I will be sharing my experiences in trading in equity and options, which I am doing for the last more than 15-20 years. And I will be giving some good strategies in investing in equity and options, which I am using for myself and for my friends, and they are giving very good results. I would request again all participants to feel free to ask questions so that we can enrich our experience to get the best out of equity and options, which is great thing. Without any investment, you can start investing without any much of investment. Shall I start, ma'am?
Yes, sir, you can go ahead.
We're looking forward to the session.
Thank you,
sir.
Equity is basically, when I was given a topic for speaking on equity, I thought I listened to many seminars, webinars also on of CAs, and they were speakers on income tax, GST, and all other matters. And they were speaking on some sections, some Supreme Court decisions, some tribunal decisions, some High Court decisions. I thought there is no decision on equity trading. There is nothing on the topic in where some sections are written in equity trading. So unlike income tax and GST law, I think it is very different from our core practice, where we practice like in income tax or GST or banking. And equity trading is just like a one-man show. You can just open Demat account in 10 minutes and you start doing trading. And the plus point of trading of equity or investing in equity is that your money cannot be lost. There is no debtor, there is no creditor. If you buy a share, you have to pay for it. If you sell a share, you will get the money without any third person involvement next day. And you can open a Demat account with any of the brokers, renowned brokers, and you don't have to pay any rental like our practice doing CA practice. We used to hire some office space and do everything. So I think this is the best option for CAs which has given our institute also has given the opportunity to trade in equity and options legally now, and you can operate anywhere in the world, and your at 3:30 your shop closes and you are free Friday to Saturday, Saturday to Sunday, and there's no debt, no tension of goods stolen or your stock stolen, nothing like that. So
Sir, excuse me, sir. Just a minute,
yes.
sir. Nanda sir, he may join right now. He from Maldives.
Sure,
Okay.
sure.
In case he is joining, then he can speak 5 minutes, sir.
Definitely,
Otherwise, you can continue, sir. Please.
definitely,
Thank you.
sir. I would love to
Sure, sir.
welcome him.
Okay.
Basically, there are three. We can compare equity investments or future options trading in like cricket match. There is three formats of cricket match: T20, 1 day, and 5 day match. 5 day you can compare it like it is a mutual fund. You don't have to do much of it, and it is like a long-term investment. 5 day match, and in equity trading you can call it as a 1 day match where you invest, stay with some shares, then you get out of it. And T20 is future and options. They're in expiry every Thursday, and it is just small. And within a few days, either you lose or you win, whatever your strategy is. But it is just like a T20 match. So I would suggest all the CAs. First of all, let me know whether all the CAs are doing trading in equity and future options. Are they have got DMAT account or not? They can write down their question, and moderator can tell us. It will be much easier if everybody is doing option trading and equity trading, so that I can explain much better my strategies also. Basically, for equity, thumb rule is how much you should invest in the shares and how much in the long term, how much in gold or like that. If thumb rule is your 100 minus is your age. Suppose you are 30-year-old and 100 minus 30 is 70. You should invest 70% of your liquid balance in aggressive markets like equity, like mutual funds, or like that. One should, the more you get ager, you take lesser risk, and you should invest lesser. And in the younger age, you should invest in trading of options and equity also. We basically in equity market, everybody is Abhimanyu. Everybody has heard Mahabharata, and everybody is Abhimanyu. Everybody knows how to enter the market, how to open a demat account, but nobody knows how to get out of it, how to get out of that chakravyuh so that you will be a winner. And it is very easy to enter in the share market, but it's very difficult to get successful. It's just like Abhimanyu, but we have to become Arjun of this share market. We don't have to be Abhimanyu. So I can share my live examples and I can tell you my strategies so that which I am using for more than 6 years before COVID, and they are so successful and giving me results of more than 15 to 20% annually, other than your dividend and interest. And I can share my Excel sheet and I can tell you how to invest in equity, my strategy. I'm very practical. I'm not going to say theory. I'm just telling you how to invest in shares. If you got money and which is not available for you for next 2 to 3 years, then I have got a very excellent strategy, and I have made that strategy for 20 lakhs. In case, suppose for 20 lakhs, if we have got 20 lakhs to spare for when we don't have for next 3 years, then I've got a very good strategy from where we can get very good return of more than 15 to 20 years. Sir, most welcome.
Thank you. Thanks a lot, Kapoor sir.
Yes, sir.
Good evening, sir.
So very good evening. I can see Madam Geeta Devi
Yes,
from
sir.
Imphal. She's here even though she's not well. My very dear friend CA Sanjay Kapoor. We have been together for so many years as senior chartered accountant from Panchkula, Punjab, Haryana. Gaver PDG from the committee. We have Mr. Animesh Singh from the committee, Mr. Sanjeev Sancheti, the past speaker is there, and I can see Ashok from the technical team. Ladies and gentlemen, my unconditional apologies for not being able to join earlier. In fact, I was in Maldives, and there was no connection of, even my phone connection was not working. But I couldn't stop myself when two of my very dear friends, Sanjeev Sancheti ji and Sanjay Kapoor ji have come. So I thought I should address. Ladies and gentlemen, the stock market today is at the highest boom. You can create value and worth by investments. And all the programs which we do, the basic purpose is to educate you, to create awareness, how you save your capital and let it grow, how you create value and worth by investment in stock markets. I will not stand between you and Sanjay Kapoorji, the worthy speaker. I couldn't join Mr. Sancheti's session, but I was very keen to join this session today. So Mr. Sanjay Kapoor, if I put in few words, is a master of derivative trade. He has devised certain ways how to create value and worth. And you all know that the Institute of Chartered Accountants of India, under the aegis of the Council, have allowed chartered accountants in practice to undertake derivative trades in equities and currency segment. So largely, it is something that will change your entire mindset. It will put you at a parlance where you can invest wisely, taking care of risks and creating value and worth. So ladies and gentlemen, thanks. I wish this conference all success. So Geeta ji, I would withdraw. Thank you, Sancheti sir. Thank you, Kapoor sir.
Thanks a lot for the kind words. Thank you.
Bye-bye. Bye, sir. Bye.
Thanks for the kind words, sir. It was great
Great.
seeing you.
Great. Thank you. Thank you, Kapoor sir. Please carry on. Sorry to interrupt in your session.
Oh,
You are
no,
a great
sir,
speaker.
no, sir.
Please carry
You
on.
are always welcome. You are our source of inspiration.
Sir, thank you so much. Thank you so much, Kapoor sir. Bye-bye. Bye.
So I'll tell you one strategy which I am using for more than 5 to 10 years, more than 5 years, and I'm getting results of more than 15 to 20 years per annum. Even I have this using this strategy for before COVID and during COVID also. It gave me the same results, even more than that. And I was just telling you have to. I'll just explain one model example for it. We have got 20 lakh rupees of money in investing in equity, right? Everybody is there. In case of any observation or questions, you can ask me anytime in between also.
Sir, there's a question from Delhi.
Yeah, tell me.
And the question is whether the ICICI Direct is a good platform for trading in options.
It is
I am investing and trading in equities only, but I'm not allowed to put stop losses. What should I do?
I think ICICIdirect.com is the best available platform. I am also using that platform only and making a lot of money. Touch wood. ICICI platform gives you so much things, and even algo trading has also started by ICICI trading platform. I'll not promote ICICI or somebody other platform, but you should always go for the best platform who has got the banking background also. There are some low-cost brokerage platform also, but one should always go for the platforms or the brokers which have the banking backgrounds also. And ICICI is one of them, or HDFC, or Axis, or SBI, all are having banking background. So just comparison, I tell you what is the difference between banking broker firms and other firms. In case of you have opened a demat account with some other demat account with some other organization, say Angel, Zerodha, or Master, or Motilal, but they don't have any banking account. So for trading in shares, you have to put your money in the trading allocation. You have to put money into their trading accounts, and for that trading account, the money lying idle in their trading account, they don't even earn single penny out of it. And but where the banking, where the brokers are from the banks, you earn at least saving account returns when you are trading with their broker, banking brokers. So you don't have to lose even single day interest of your idle cash, which is lying in the trading account of some other brokers which don't have any banking. All banking sub brokers are too good, I would say. I tell you simple reason, because you can't earn of the unutilized shares which is lying in the trading account. You can't earn saving interest on out of that. But in banking also, you have to you earn on daily basis saving bank interest. Even now SEBI has come with the one rule: after the quarter end, on the first Friday, idle cash is transferred to your original bank account, and then you have to again put it in your trading account. So there is another one hassles after a quarter. So you have to put again into back into Zerodha account. Your idle cash goes back into your original bank account. So I would always suggest and prefer, always open your demat account with the broker who has got the banking background also, like HDFC, ICICI, Axis, SBI, Kotak. Is my query is clear to Mr. Vinod Kumarji? Now I was just telling, there is a strategy for investing in shares, very systematic strategy. And I guess we have got, I take an example, we have got 20 lakhs in our kitty to invest in shares. And there are around 10 to 12 sectors in the market overall. I can share my Excel sheet to tell you the sectors and their shares also. And then it will be easier for you to understand also. Can I share, ma'am?
Yes, sir.
We are all chartered accountants, and we know bank will give the funding only to those business who have got the working capital of 3 months. So in case any business who has got the working capital for 3 months, he is not going to die soon, and it will always survive and make money for his business. So same strategy will go here in share market also. I always compare this share market as a jewelry shop. Same thing. Like, we have to invest in all the sectors. I was telling there are around 10 to 12 sectors in the market. And in Excel, you can see there I have written first column sector, and against that top shares of that sector. And in share market, like in I tell you the sectors. Metal in case, and we have to choose all the large cap of your shares of that sector. In metal, we can select SAIL, Coal India, Tata Steel. In auto, we can select Ashok Leyland, Tata Motors. In IT sector, we can select Infosys, TCS. Oil, we can select Indian Oil Corporation, Reliance, GAIL India, ONGC. In pharma, we can select Cipla, Dr. Reddy, Sun Pharma. In heavy metals, we can select Tata, L&T, BHEL. In FMCG, ITC, Hindustan Lever. In construction, DLF, NBCC. In power, we can go for Tata Power and NHPC, Tata Power, Power Grid. In banking, SBI, yes, ICICI, HDFC. And in hospitality, Indian Hotel and Delta Corp. I was just telling you the sector name. What is our strategy? Is like, we have got 20 lakh rupees at our disposal to invest in the share market. But we don't know how to invest, because we cannot catch at the lowest point and sell at the highest point. So unless we are in the driving seat, if we are in the driving seat, then we know when to enter, when to exit. But as a layman, we don't know when we are not in the driving seat, which sector is doing good, which sector is doing bad, and which is at the highest level, which is at the lowest level. So like in any business, we have to create 3-month working capital. We have to invest in all the sectors, because there is always a sector rotation in the market. There is never thing ki every sector will go down or every sector will go rise. In case of COVID, pharma sector was going up, FMCG was going up. Now banking is going down. There is always sector rotation in the market. So we don't know when which sector is rising, which sector is falling. So, and we have got only 20 lakhs to invest. And that with that 20 lakh, we have to invest for the whole life. And we have to earn at least 15 to 20% annually from that 20 lakhs. So I've made a very small strategy from that, keeping business as a background. And I have selected like we will invest in each sector, one share from each sector. You select, I have written n number of shares, more shares in each sector, but just select one share from each sector, which I have written. So we have got around 11 shares, which we have to invest in different sectors. We will not enter into another sector unless we have got more than 20 lakhs. So, and we have to invest for 3 months continuously. And for 3 months, that means we have got 60 trading days. There are around 20 trading days in a month. Saturday, Sunday is off. So there are 20 trading days in a month. So we have got 60 trading days for one sector. And for need for 3 month working capital, we need cash for 60 trading days. So if we have selected 20 lakhs and 11 sector divided by 20 lakhs comes out to be around 2 lakhs for one sector, 180 for one sector. And that we have to divide by 60 trading days, which comes out to be 3,000 per day. We have to put SIP of 3,000 per day of each sale, each shares every day. We have to buy that share, whatever quantity it comes. So our money will be finished by 3 months. We have got then capital for 3 months to invest in shares. If we invest 33,000 per day per share in each day, each trading day. So we have got money for 3 month working capital. You're getting me, or is there any more questions?
So there's a question.
Yeah.
What about saving of brokerage?
Saving of now every broker has come with a competitive plan. Now every broker has got his own USP. So like ICC is giving, if you sell the shares, they are giving you same day credit within 5 minutes. When you sell the shares, they give you money up to 75% of your sell amount within 5 minutes without charging anything. So there is no brokerage thing. We don't have to think penny wise. We have to think long term. We have to earn at least 15 to 20% annually. So brokerage will be taken care of with that very easily.
Sir, is Paytm Money a good platform for investing?
Does it has a bank?
They do have a bank.
No.
No.
They don't have any bank.
Yeah, but
it is
heard
backed by bank. One should not go for it. I would not suggest it. Unless it is backed by bank. So I was telling my strategy, like if we want to invest and earn in shares, we have to keep money for 3 month working capital. For 3 month working capital, we have to invest in every sector and top share of every sector. We have to go for large cap only. And only 80% you can go for large cap, 20% you can go for the small cap. As you have seen in the old movies, there is around 6 to 7 songs in a movie. And 5 songs are too good in all gold movies. Only 1 song is your item song. So you can keep only 10 to 20% shares in small cap or large cap, mid cap. All other 80% to 85% of your investment should be in the large cap only, which should be Nifty share or ex Nifty share. The shares I have written, these all are Nifty or ex Nifty shares. And only 1-2 shares you can go for mid cap, where you can use for beta companies. Like I have chosen here DLF, or you can say Yes Bank or Delta Corp, like that. Only 1-2 share we have to invest in small cap, because if large cap doesn't rise so fast, but they don't fall also that fast. So we have to first keep our capital intact. It should not be washed away. And by investing just 160 of your amount, 160 means 3 months working capital. You have to invest just 33,000 per day. Whatever amount shares come into your kitty, by buying 33,000, you have to invest 3,000 in one share of each sector, and whatever amount it comes, and it will buy automatically. Most of the brokers give this facility of daily SIP. You don't have to worry. You don't have to log in daily and go for investing 33,000 daily by login. It is given by all the brokers. It is done by daily SIP. You can simply put daily SIP through any of the brokers. They all provide this facility to you. It's not that difficult.
There is a question of
Yeah.
how to put stop loss to my trades in ICICI Direct.
Stop loss in my trades. Does it trades in futures, options, or equity? My question to him is, he wants stop loss in equity or future options?
Yes, not answered.
Because in equity, you don't have to put stop loss. If his question is for stop loss for future and options, then while doing my option webinar, I'll tell you how to put stop loss, or you don't have to put stop loss. You don't have to put stop loss in equity. In my strategy, you will buy 3,000 of shares every day for whole of your life with this 20 lakh rupees. It will not finish it off. I'm just telling you just the entry point right now. We have to invest 33,000 per day for the next 60 days. Not 60 days, for the whole of the life. But there is exit policy also. After putting 33,000 every day, there will be sector rotation in the market. Some sector will rise, some sector will fall. It is not like that ki every sector will fall or every sector will rise. So after 10-15 days, you will come to know through your portfolio that some of your shares are giving profit, some are giving you losses. So my exit and profit booking will be when we see profit of 5 to 10% in any share, in any sector, we will exit and book the profit. Whenever I see 5 to 10% profit in any share, in any sector, I'll exit that share, but I won't stop my daily SIP. It will generate cash like a jewelry shop. If you buy a jewelry, shopkeeper buys a jewelry at 50,000, he purchases jewelry for 50,000. If the customer come and next day jewelry rate is 48,000, he won't refuse to his customer, okay, I won't sell you to at 48,000 because my cost price is 50,000. But in equity, you have got the option. If you bought a share at 50,000, but next day share is 48,000, you won't accept the seller option. You will say, I'll not sell it unless it rises more than 50. So it is better than any jewelry shop or any shop. You have got the option whether to sell to him or not. And you will sell only when it is in profit. So there is no question of stop loss also. Because even if it is going down, any share is getting down, and you are not getting opportunity to get it out in the next 3 months, but it won't be possible. You won't get in any other share profit booking opportunity. You will always generate cash by booking profit 5 to 10% whenever you get the opportunity by seeing the portfolio. Exit is manual. Entry is always automatic. So, and you have to churn your this share of 5 to 10% at least 5 times in a year. And it is possible 5 times a year. Each year you will get an opportunity to churn 5% to 10% 5 times in a year with profits. So you will easily get 15 to 20% of your achieved margin, profit targets. Any other question? It's come? No.
So no question. His question was with respect to equity stop loss.
So there is no, in this theory, we don't have to put any stop loss, because if we buy a share daily on daily basis, you will always be near to your market, because you will not miss a single opportunity of to average it out. You are buying on daily basis and very small quantity, and you will always be near to market. Whenever any share rises, it will give you enough profit and you can exit anytime. But you don't have to attach emotionally yourself. You have to exit. You can't say this is my favorite share. My profits are it's showing 5 to 10% profit. I won't exit. No, you have to write down your strategy, black and white, in front of you. Okay, after getting 5% to 10% in my portfolio percentage profit, I'll exit it. And with this, you can make a lot of money, and your 20 lakh amount will never be finished. It will always be there, because you're churning your shares. Whenever you are getting profit, you are converting into cash, and it is going to go longer and longer, and your working capital will never be finished. It is just like an EMI of your any loan. 33,000 per day is just like an EMI of your loan, and you can't miss opportunity. If your cash is going to be finished, you don't have cash for more than 2-3 days to invest, then you have to exit. Even if any share is giving profit of more than 2%, 3%, but you have to generate cash to buy, because that generation of cash will be invested in 11 shares, and you cannot afford to miss any opportunity of daily buying. And by daily buying and by daily averaging, you will always be near to market, because when the market comes down, it will buy more quantity. I am buying on amount basis, not on quantity basis. Suppose I bought the Steel Authority of India at the rate of 100. It comes down to be 90 rupees. At 3,000, it bought 30 shares. But when it comes down to 90 rupees, it will buy more quantity, and it will make me better average. Are you getting me? Well, if share is high, I am getting lesser quantity. If share is coming down, I will get more quantity out of 3,000. It is as simple as that. And my average will be the best in the market. I think there is one more question.
Does technical analysis really helpful for retail traders in derivative?
I don't think so. I am not a technical, I don't do trading in option through technicals. I don't think technical analysis is helpful, because it doesn't consider many of the things, like it cannot consider COVID, it cannot consider your Ukraine war, it cannot consider any mishappening which is done. It is technical analysis is always based on the past data, and past data cannot be go as you have to consider current conditions also. So technical is just अपने आप को तसल्ली देने वाली बात है, nothing more than that, I would say. Pure mathematics works. If there is no profit, you will exit. Will you exit? If no exit, how will you reinvest after 3 months? I will exit even if my profit is 1%, if I don't have any cash to invest. It is as simple as that. I cannot stop my factory of working capital. If I don't have any cash, I'll bring more cash. But I cannot afford to stop my daily SIP of rupees 33,000. And for the last 5 years, not even a single day has happened to me in which I have not invested. I always get opportunity to exit. if you are sincere to book profits, you will always get the opportunity and you will always generate a cash. That is for sure. And that is my last 5 years experience, more than 5 years experience. Not even a single day has been left out. One of my share, which was B class, I tell you example, was stuck for more than 1 year, and I didn't get the opportunity to exit. But in other 10 shares, I was getting exit, and it was I'll tell you the name of the share also, Alok Industries. I put 20% of my portfolio in small cap and mid cap also. So Alok Industry comes into the category of small cap. And the last 1 year, I didn't get the opportunity to get out of it with 5% or 2% returns. And it got accumulated for 1 year. But when it jumped, it gave me the best profit of all the shares. I have just exited it, and it has given yesterday and day before yesterday, it jumped by 7%. It averaged out my best and it gave me the more than 20% return. And you can imagine the profit I made by accumulating 1 year in Alok Industry. How much quantity should I would have had, and how much profit I would have made. So there is no possibility that all your 11 top large cap share will not give you opportunity to exit. Even if they are not giving 5 to 10%, even if they are giving 2-3%, do exit. But don't let it stop your daily strategy. Now, 33,000 is bit higher sum. Don't think 33,000 as a one way. Maximum limit is 20 lakhs only. I have just made for 20 lakhs. In case you have got lesser amount, like if you have got 10 lakhs instead of 20 lakhs, make it 1,500 per day. I have just given one model example for it. This is answer to Mukesh. So it is as I have made this model example for you for 20 lakhs. You can do accordingly. If you have got 7 lakhs, 6 lakhs, you can do 1,000 per day. But don't skip any sector, because we are not in the driving seat. We don't know which sector is going to rise, which sector is going to fall. Because of Europe, IT was falling. Because of Europe, IT was falling. So we cannot predict which sector will go or which sector will fall. So we cannot take the risk unless we are sitting in the driving seat. If we are sitting in the driving seat, then we will go naked. Then we will go only with one share. Why with all the shares? We are covering all the sectors because we don't know. We don't know the insider information. That's why we are going for the large caps only. Hello. And one more question by Om Prakash Agrawal is, suppose I sell Infosys at profit, I continue to buy daily at the same time, 100%. This daily shift should not stop throughout your life. This is just like your investment on daily basis. It is just like your EMI now, and which is going to give you more than 15 to 20% profit annually. More than that, I am very conservative on this, telling you 15 to 20%. It will give you more than 15 to 20%. And all are dividend paying companies, and dividend and interest earned for the unutilized cash will be extra than 20%. So you stop your strategy. Once you earn one more 2 lakh rupees, add one more sector, add one more push, add one more share to your kitty of different sector. No. One question is from Francis. Do you switch shares in sector? Initially, I decide. That's why I make the list of 3-4 shares in each sector. Once I decide that share, I won't change it. I can add one more share into it, but I won't change my share, that share. Initially, I take some time and decide. And always, I tell you one more thing into it. Always go for shares which are near to the value of rupees 100. or less than 100. There is a reason for it. Don't go for bigger amount shares. Here, 1, 2 shares are of bigger amount, like Infosys, TCS, but we don't have other small shares in IT sector. So, why I am telling you, go for less than 100 rupees share, because in case there is a fall in the market of that share, you will buy more quantity of that share, because it is less than 100. You will buy more quantity. In case it is more, 1500 rupees share, it will buy 2 share or 1 share only. It won't affect any your portfolio. But if you are buying share near to value of rupees 50, 100 rupees, then your quantity will be changed once the share falls or rises. If the share rises, it will buy the lesser quantity with the same 3000 rupees. That's why always try to get the shares which are equivalent to 100 rupees. One more question is Sumit Jain. Views on IT sector. IT is one of 11 sector for me. It is just like 1 out of 11 out of me. It is just 1 share for me out of 11 shares. So I don't marry to any sector. I always invest in every sector. I cannot afford to miss any sector. So I'll not put my all money on one sector. I'll distribute all my money equally in all sectors. One more question is there. Sir, what about the idea of investing and holding HAL for a long time? And I had invested sometimes back, say 5 months earlier. It was double now. And why I want to hold to next 3 to 5 years, your take. Sir, for this, I can give you simple answer. If you have made double money in HAL, book the profit and put daily SIP out of it. After some time, you will again accumulate same number of quantity of shares what you have sold it now. Profit booking is more important than investing. So book the profit and put it in the daily SIP. After some time, you will accumulate same quantity. And whenever in between you get the opportunity to exit, please do exit.
So there is a question. May we know the performance of this strategy? Like
I invested with the same strategy, it gave me better results than normal situation. Because market started rising every day and I never put all my bought my shares in one day. I always had money to invest in 3 months and my average was the best. I didn't miss any single day to invest in the share. One more question is this. Sir, may we know the performance of this strategy, like from how long are you doing it and average annual returns? I am doing it for more than 5 years and my average return is more than 20% to be fact. And dividend and interest are separate.
views given on TV channels should not be followed, or should we take
Views given on TV should not be followed, or should we take contrary position to that? They are just for your entertainment. They don't never go for TV channels. Don't go for channels. And what I have told you, the strategy you will not find anywhere in YouTube, anywhere. Nobody will tell you this strategy, which I am telling, which is proven for more than 5 years. And I am doing for my friends also. No, TV is good for watching, just for your entertainment. Take off your attentions. Nothing more than that. Nothing more than that. Sir, could you summarize the strategy once again at the end of quick recap? Definitely, I'll do that. What about
railways?
Like RCT, when you 2 lakh rupees, add railway as one sector and add one share out of it. Whenever you earn 2 lakh, you are ready, you are prepared to invest in one more sector or add whichever is your sector, one more share in that sector. As simple as that. So whenever you first initially invest in 11 sector, your no sector should be missed out. Then when you earn 2 lakh rupees, add one more sector or one more share in any of your favorite sector. But always invest through SIP only. You will never regret. Ki, one more question is there, I suppose. Sir, could you summarize strategy once again?
Please throw light on some public sector companies like IRTC and HAL.
On public sector company, I would always say, always go for the profit-making public sector companies. Or go for Maharatna companies, Ratna companies. Always go for public sector companies. I always go for it. I was independent director with Indian Oil Corporation for 3 years. I can tell you with my experience what government needs. Their shareholding is more than 50% in every government company, public sector company. So what is their income of government? Through dividend only. So always go for profit making dividend paying companies, so that at least by force they will tell you to distribute 30% of their profit through dividends, because government earning is only through dividend. They can't sell the shares. So even if you are stuck in your shares, you are not able to book profit in that shares, but you will earn more than 10 to 15% through dividend only. Always go for profit making dividend companies. Don't go for loss making public sector companies. Always go for which are giving good dividends. Every public sector profit making dividend public sector company is giving very good dividends, equivalent to 30% of their annual profit. Any other questions on this?
No more questions, sir, for now.
Shall I continue again?
Yes, sir.
Okay. Because this is the only strategy where you can confidently enter into the share market without any hitch. I can say with very confidence, with my 5 years experience, more than 5 years experience, this is the only strategy where you don't have to think upon. But always choose large cap companies, always choose all the sectors, and always choose shares which are near to rupees 100. Is that clear? वैसे तो कहते हैं कि when you enter the share market, गीता का ज्ञान हो जाता है, सब कुछ पता चल जाता है, आप क्या लेकर आए थे, क्या लेकर जाए हो, सब कुछ इधर ही छोड़ जाना है, सब कुछ ले जाना है. But if you plan according to your business plan, so you can make wonders. And at least always invest in shares which are Nifty or ex Nifty, which were in Nifty or ex Nifty.
Sir, there's a question.
Yeah.
Where can we get a list of companies in which the government has stake of more than 50%?
All PSU companies, public sector companies. All public sector companies, they are all, you just Google Maharatna companies or Ratna companies like IOCL, BPCL, HPCL, or you can have lot many companies, GAIL, BHEL, SAIL. Select all the different sectors. Sir, what about the idea of adding government focused sectors like infra? They are little slow. You will not be able to book profit very fast. You have to be churning. You make in back of mind. You have to think so that you can churn your share 4 to 5 times in a year with 5 to 10% profit. So with infra sector, you won't be able to churn that much. Give the list of PSU declaring good dividend. All profit-making dividend PSU companies. You can Coal India is there, HPCL is there, IOC is there, SAIL is there, BHEL is there, GAIL is there. and NTPC, NHPC, all. You can go anywhere, go to different sectors. Government is in every sector, you can say. In banking sector, you can go for SBI, LIC. These are all in every sector. You will get some good government company, like in metal, SAIL, Coal India, auto industry में नहीं है अभी, IT में भी only shares floated नहीं है, oil में है, IOC is there, ONGC is there. You can always go there. Heavy metals में BEL is there. And construction में NBCC is good company. Even for dividend, you can go for electricity companies. Power में you can go for NHPC, Power Grid of India. In banking, you can go for SBI. Shall I move to option trading also? There I can tell you some good strategies, or like SEBI ki one report of SEBI has come, and which is floated in every TV channels everywhere. Like 9 out of 10 trades are in losses.
Sir, there are two questions.
Tell me.
If they're paying huge dividend, then there'll be less chance of creating wealth.
What is if the paying huge dividend, then there will be less chance of
creating wealth.
Why? Dividend is also your income. Dividend will add to your income. If you don't want to earn dividend, because now dividend is taxable, it won't make any difference. Earlier it was tax free. Now it won't make difference. You sell before dividend, ex dividend, or before dividend. When they declare dividend, you can sell your share before record date and earn, because the share price is high before dividend.
And there's also one more question. What is your opinion on real estate investments, considering the currently growing economy and urbanization?
Go for NBCC. Construction and this real estate is also one of the sector, out of which you can select NBCC, DLF company. You have to cover every sector. Don't be specific on one sector, and don't love or attach emotions to any sector. You will not able to sell then profit in that sectors. One more question is there, I think.
Recently, public sector banks are showing good profit, lesser NPAs. List out some good PSU banks from medium term perspective.
Sir, again my question is to you, how much you want to invest? Suppose you want to invest 1 lakh rupees in that bank. Divided by 50, it comes out to be 2,000. Buy 2,000 of that PSU bank every day. There will be no loss. Your question is like you want to invest in one go. Why you want to go invest in one go? Any amount you want to invest, divide it by 50 or 60 and make it daily SIP. And you will be able to churn it so many times in a year, and your money will not be finished, and you will getting profit out of it. All sectors are good. I have got 11 sectors. Defense is also one of those sectors. Suppose I sell ITC on profit. Should I continue to buy the same with daily SIP? 100%. Your SIP should not be stopped. Otherwise, you won't be able to sell, take the profit. You will take the profit because you know next day it will, same day it will also buy with smaller amount. Otherwise, your emotions will not able to sell that share. If you have put the SIP, daily SIP, only then you can sell the that share. And it will continue throughout. After some time, whatever profit you have booked through shares, it will again be accumulated, same quantity, after some time. And with better rates, because it will not miss any opportunity, daily opportunity of buying.
Please explain option Options
Option
trading
trading.
strategies.
So some people are here who do option trading also. So I also do too much option trading, but I do it through algo. Nowadays, algo is very in thing, and one should not do option trading manually. It's very risky because SEBI has come out with the report that 9 out of 10 trades taken in the options are in losses. Only 1 out of 10 are in profits. And I am feeling very proud that I am giving this webinar to all the CAs, and which are winner 5 out of 100. Our same CA results also come 5 out of 100. We get pass only 5. 100 people give the exams, only 5 get it passed. So same is with the options also. Only 5 out of 100 get successful. So first thing you have already achieved. You are already out of 5 out of 100. You have made your career in CA by throwing 95% out of your competition, and you are selected 5 once. So option trading is not at all a difficult thing for CAs because they have achieved this thing before. Now they have to achieve this thing in option trading. I suggest one thing. Always people were saying I don't use stop losses. How to put stop losses? I suggest never put stop losses on equity because equity is not going to die. If you have bought any share, it is lying in your demat account. Any broker or anybody cannot sell that share without your permission. But in option trading, there is an expiry. Every Thursday, you have to cut or your broker will cut your positions. So stop loss is compulsory in option trading. But most of the times I don't put stop losses. I made a tool or I made a strategy where stop loss is inbuilt. Shall I tell you how I also don't put stop losses, but I do lot of option trading. Oh, few more questions are there. How do you select which share in sector to be purchased in particular day? I first write down the sector name, then I write again the sector, the best shares. So then I choose which one is to be bought per day. Like I have, for example, I am sharing my Excel sheet with you. I have written many shares. You have to choose only one share or any other share of that sector of your choice. It is not final or final list. You can add your share of your choice in that sector. This strategy has capital appreciation also, definitely, but you have to exit accordingly. Every 5 to 10% of profit you have to exit, and you have to buy daily. Sir, the quote of Warren Buffett that my holding period is lifetime is not relevant for Indian scenario. Everybody has got his own winning strategy. We cannot copy anybody's winning strategy. Everybody has his own style. Sachin plays differently. Tendulkar Kohli plays differently. Now Surya Kumar Yadav, he doesn't follow any sporting rules. He play differently. Everybody has different passion, different strokes to play. So you cannot quote anybody or copy anybody. Please guide some on future. Stop losses are more important than profit in options. Yeah, definitely stop losses are more important than profit in options. But if you inbuild your stop loss while taking the your positions, then there is no need for stop losses. What I do, I never do naked trading in options. I always do pair trading. So your stop loss is inbuilt. Can you understand what is pair trading? I never do naked trading in option. I never buy or sell a call or never buy or sell a call naked. Only one. If I buy a call, I will also buy a put. I always do pair trading. So there is stop loss inbuilt in it. If I buy a call, I will sell accordingly of call of different strike price. So there is inbuilt stop loss. There is if you do it pair trading, there will always be a limited loss, limited profit. So your stop loss is inbuilt when you take the position. Always do pair trading. Whatever pair suits you. That is tangle, straggle, iron condo, whatever you like, spread or anything you like. But never do naked trading. So you won't repent. Your stopper loss is inbuilt. If you are bought, like I'll share one more thing with you of my option trading. After 3:30, I do some homework also. I'll just tell you. This is from this to this. Can everybody see my screen? Can see my screen? This, whichever I highlighted it. This is basically closing price of the lowest pair of that day, Wednesday to Thursday. And left side, these are written expiry dates. These are 11, 5th expiry. I'll sharing my, what I do after 3:30. I make the total of call and put of the lowest call and put. Lowest means the same where new future has closed down. Nifty rate. Like yesterday, Nifty closed at 19,350 or 400. So lowest rate was, this is the sum total of call and put. And you can see how it decays. People says you always make money by selling the call or put. I make always money by buying a put or call. I always buy a pair. Like these are the pair cost. Yesterday, Thursday. Yesterday was Thursday. The lowest, no, it was Friday. So I haven't written. This was 173. Forget to write. Lowest rate for the call and put, both of the same strike price was 202. So it cannot go less than, on Friday, it cannot go less than 174. It cannot go less than 148, 51 on Monday. I know the pair total on each day from Wednesday to Thursday of each expiry. So I have got a no. I come to know that this pair cannot go less than that. So I'll make my strategy according to that. This is Independence Day, so this pair was lower, and this pair cost also changes with the VIX also. If VIX is more, your pair cost will be more. Now VIX is little higher, your pair cost is little higher. So I make changes accordingly.
Sir, we have many questions.
Oh, let me answer the question first, because I want to make this interactive session.
How do you select which share in a sector to be purchased in a particular day?
I bought share of each sector on each day. That's why my shopping is 33,000 per day, covering 11 sectors. So this strategy has capital appreciation. Definitely, when capital appreciation is there, you will get the exit policy, you will book the profits. Sir, that quote of Warren Buffett holding, everybody has different policy. Please guide some on future. I'm telling you option trading. Stop losses are more important. I've told you, I build, my stop losses are inbuilt in my strategy only. I never do naked trading. I always do pair trading. You also start doing pair trading. It will always give, cover your stop losses. Sir, please explain option strategy before time runs out. I've told you, this is the chart. I know what will be the lowest cost of the pair in that particular day of that particular expiry. I have written all the expiries from 11th May till 28th of August. I daily write this lowest total of the pair of Nifty. This is Nifty total. Pair of Nifty. I do Nifty trading only. What is this? What is your view on artificial intelligence shares, Tata Alexi like? If it is you are buying on daily basis, you don't have to go for any artificial intelligence. Your intelligence will be more important. close position have limited profit but guaranteed. I didn't get the question. Puts or calls of the same strike price, lowest price. I go for the lowest pair. This my computer calculates through algo. Sir, not always put and call become zero on expiry. Never. They never become. It's for sure. At what strike price is this total call put? These are the strike price near to closing rate of Nifty on that day, because it is always lesser premium on it. There is no instinct value on it. So these are mostly these total is of Nifty closing price only of that particular day. How to take exit decision from a share? I tell you one thing. You buy a pair of what I have written. You buy a pair of call and put at 3:30 or 3:20 at the closing time, right? And in the morning before 10:30, you exit that pair, even if it is giving you good profit or loss. If any swing comes in the night, it can double or make 10 times of your profit also. But your loss will be limited to 5 rupees, 5 point only. Because I know the next day lowest total. These totals are of 3:30 p.m. So always buy pair at the closing time, 3:15 to 3:30, and exit next day morning 10:30, before 10:30. In case there is any news, bad news or good news during the night, you will double or make lot of money in the morning.
How profit is earned through buying?
Huh?
Prices. How profit is earned through buying?
How profit is earned? Because you have to exit very quickly. Because next day decay, you have to exit your this position before 10:30. Before 10:30, there will not be much of loss of premiums. What you have bought previous day at 3:20, next day till 10:30, it will be maximum loss of 5 to 10 points only, maximum. But profit can be 100 points, can be 200 points, can be 300 points. How profit is earned through buying? Price is decreasing day by day. It is decreasing during the day, basically. If you are buying at the closing time of the day and selling at the morning when the market starts, your decay will be very less. My voice is not clear. How to take a big decision on the share? You should exit when you are getting profit of 5 to 10%, or your cash is going to be finished. Only in two situations you have to exit your share. You have to book profit. Sir, beside trading with 5 to 10%, do you allot some amount on long-term basis? If yes, with what strategy? No, I don't attach emotions to any share. It is just like any shopkeeper attaches his goods with emotions. And you can ask any jeweler. He has got good collection of jewelry. Does he refuses to sell that jewelry, even if it is very good made, to any buyer? If you go to any jewelry shop and if he has got any special emotions on particular jewelry, will he refuse to sell it to you? If answer is no, then same situation is here. If he is able to sell you his jewelry, best of his jewelry, then you should also exit your share when it is giving profit.
Sir, can you please share which strike, call, and put should we buy?
It is the lowest sum. The lowest sum of the call and put should buy. It will always be near to your current Nifty rate, or 50 point upper strike price, because premiums are made from the future point of view, and future has got the premium. Does the Greeks important in option trading? Everything is important, but we should know when to exit, when to enter. Sir, can you elaborate the complete strategy? Which one, equity or option? Which one, ma'am?
No question, sir.
Okay. I'll just sum up the my equity strategy. That is more safer, because the thing which you have bought and put it in your demat account, nobody is going to sell it without your permission. Option is only for professional traders. It can give you double the money same day, but it is too risky. SEBI has already come out with the report. 9 out of 10 are in losses, but you have to take care of your risk management. That is more important. I just explain your this equity strategy. I think he's asking for equity strategy. Summarize it.
Option.
No.
Option strategy, sir.
Option, there are more option strategies, but what I am doing right now is buying option pair, call and put both at 3:30 or 3:20 before closing, and selling in the morning before 10:30, whether it is loss or profit. When profit will be there, it will give you at least 10 times. It can give you 10 times the profit, but loss will be very limited, up to 5 to 10 points only. Options are, I already told you one of the strategies. Otherwise, other strategies are covered calls, or if you want to buy equity in lump sum in large quantity, then always sell put of that equity, and when that put shows you loss, then only buy the equity equivalent to lot size, minus 50 point less put and 50 point more call. You can, it's your opinion. You can change your strategy. There you can make n number of combinations. You can go for, you can try this also, 50 point less, 50 point more, anything, any combination, but always go for pair trading. Never go for single naked trading. You can make n number of combinations. You can buy one, sell one, buy call, sell another call of another strike price. So you can make, it's your कौन सी आपको सूट करती है, किसके साथ आपके ग्रह मिलते हैं. Just try, then do that strategy.
Please explain option strategy for a layman.
Option strategy for layman. In case you have got good quantity of equity lying in your demat account and you don't want to sell that equity, and that equity is giving you profit, always sell call of that equity of higher strike price. It will give you rental of around 2% per month. Like I tell you, I give you again example of it. For example, you have got Steel Authority of India. You have got 8,000 share lying in your bank account, demat account, and current price is 84 rupees. You sell 85 rupees call at 3.5. You get 28,000 in same day. And this is profit percentage will be 28,000 of 7 lakhs. You can understand it is 28 divided by 7 lakhs. It is 4%. You will get return of 4%. If your call shows loss, sell the equity also accordingly. It is, and you can, for Ashok Leyland, I also made same thing. Current rate is 186. And if you have got 5,000 quantity in your demat account and you don't want to book the profit, sell the call of 186. You will get 40,000 straight away. When your call show loss, sell the equity. Otherwise, don't always sell calls of the same strike every month. You will you will get return of 40,000 divided by 9,30,000. 40 divided by 930 multiplied by 100. Again 4.3%. You will get the return of 4.4% per month. You can have n number of strategies with the combination of equity and options. Some more questions are there, I suppose.
When can one take naked position confidently?
When can one take naked position confidently? When you have got insider report. When nobody else has got the any report, only you have got the report. And you know it. Like on Satyam News. Only Satyam News. Satyam people or Satyam owner knew it. Ki I am going to declare this thing on TV and it will fall down. If you only have got the news, nobody else, then you can, like on recently, if anybody has got the Hindenburg report before one day on the Adani, he would have bought a lot many puts, and he would have made 10 times, 15 times, maybe more than that. Only if you have got the confirmed news with it. You must have seen one Bond movie. It's named. It started with this only. Ki you buy the puts of that particular air company because the terrorists were going to blast that air company. They knew it. Then the share will fall off that air company. So he told his broker to buy the puts of that air company. So broker told him, sir, this company is going to rise very high. Why you are saying this? He told terrorist, it's my money or your money. I told you to buy puts. So, but James Bond come into position, company survives, and he lost all his money. Even you must know 9/11 ट्विन टॉर्स जो स्ट्राइक हुआ था उसकी इन्वेस्टिगेशन करने से यही पता चला था दे केम टू नो द टेररिस्ट बिकॉज ऑफ ऑप्शन ट्रेडिंग ओनली हाउ मेनी पीपल have bought puts on that particular accumulated puts before that, and only with that clue they came catch up with the terrorist only. They knew before event कि this is going to happen. They bought lot many puts and they made lot of money. Like same. No questions?
No.
Invest. Loss is the real guru basically. Whenever you make loss, you will always learn. Always you should have, like naked, you should have always some put out of the money in your kitty, because bad news come unexpectedly. Coronavirus, Russian war, airstrike by India on Pakistan. It was on Thursday. It was expiry day, and market lost around 400 Nifty points on that day. I remember when India strike on Pakistan. Satyam Computers, because good news always comes beforehand. Everybody knows good news is going to come. Bad news, because birth of a child, it takes times. But death comes instantly. So one should be prepared for bad news. And for bad news, you have to buy puts. Friends come to me, they say, I've got too much losses in future option. What should I do? I simply ask them, if you have done same thing, same positions, oppositely, you should have made that much profit. So most of the times, people make profits. But what our human nature is, we take small profits and give big losses. We don't have any risk management. So I always suggest, because nobody is expert in this market. So risk management is very important. And for risk management, you have to do pair trading or book stop losses. And one more thing, new thing has come, which can overcome your emotions. That is algo trading. You should start algo trading. A lot of many brokers are providing algo trading on their platforms. And it doesn't take any emotion. It books profit, scalping is there, averaging is there. Lot many algo things are there in the market. I have customized my algo trades from some developer. Any more questions?
Is open interest information of any use?
Definitely, it is of use. Even after market hours, NSE provides you the information of FI and DIA data also. How much equity they have bought, how much open positions they have got call and put. It is of use. Back of mind, you can always see FIAs are negative on the market, on Indian market, or positive. They are bearish, or earlier, before a quarter, they were too much bearish on our market and they were selling. Now they have come up with and buying on daily basis. You should always take track of these news, what FII is doing in our Indian markets, because they are the big buyers. They do buy around 10,000 crore worth of equities per day, and they do a lot of option trading in our market. So it gives you back of mind whether what they are doing. They are exiting from our market or they are entering into our market, back of mind. But that only should not be the reason to buy or sell. It should be in back of mind. It should be one of the tools, but not the only decision making thing.
So whether you make profit out of every option trade?
Whether you make profit out of, no, I am not God. I told you, if I have got limited loss and unlimited profits, I am always there to give losses also. Losses teach me better lessons than profits. Profit make me lazy and losses make me alert, so that that thing should not be repeated again. Nobody is perfect. Nobody is there who cannot make losses. You will make losses if Nifty moves in single direction, either upwards or downwards. Any other?
No questions as of now, sir.
I think time is also getting over, or some QA.
Capital protection is more important. There is a question, sir.
Okay. Capital protection, definitely. If your capital is wiped out, how will you survive? That's why if you have got 100 rupees, always put 10 to 20 rupees in option trading and 80% in your equity. Option trading should be for your fun sake. It's nothing more, not more than that. It will keep your BP intact. 20% less than the option price is good strategy. So it depends. If it suits you, go for it. because there are n number of combinations in option trading, in pair trading. You just cannot count it. It's just like chess. There are n number of combinations you can make. Whatever suits you, go for it. There is not even a single strategy which you can say it is foolproof or it will give you always profits. If it would have been there, any foolproof strategy, it would have been written in the books and taught that only. It cannot be. It is always different combination. Some never one strategy cannot give you profits all the time. Otherwise, it will be printed in the books. Any other questions, or shall we conclude, ma'am?
We don't have any questions as of now.
Or I can go further in case anybody is interested in that. Always, one more thing, one should, as a CA, I must tell everybody should open a demat account with his current account also, so that if you don't think equity trading or option trading is good, don't go for it. And but your idle cash should be deposited in liquid mutual fund. Liquid mutual fund is as good as FD. So whatever idle cash you have, you should keep it. You should have demat account with your current account, and liquid. There is no exit load, no entry load. So, and it is when you redeem it, it comes in one day in your account. Money will come. So whatever extra money you have in your current account, you should always keep it in liquid mutual funds so that it can earn something, idle cash. And always have nominee, and always update your family members about your finances, about your demat accounts, always your trading things, so that in case of any mishappening, they should know. Or always tell your family members about the brokers, so that they should always know what you are doing, and always write a will. It always helps out, because in some cases I've seen in my clients, they have suffered a lot.
There is a question, sir. Why are bank Nifty lot size reduced? Because our small size lot is costing more than earlier.
This question should go to SEBI, NSE. Why Nifty lot size reduced? Because of small size lot is costing more than earlier. Sir, they know people are getting into market too much, because our option trading is one of the most world's traded platform. It is the world's most option traded. So the keeping smaller size, they'll get more brokerage, more STT, more everything. No person can give assurance. No person can give assurance. Only God. मैं तो सिंपल सा एक रूल है विच गिव्स मी काम कूल, वो रामचरितमानस में क्लियरली लिखा हुआ है कि 6 चीजें हमारे हाथ में ही नहीं है. वॉट एवर यू डू, दैट 6 थिंग्स आर जीवन मरण, हानि लाभ, यश अपयश, ऑल इन गॉड्स हैंड. सब विधि के हाथ, हमारे हाथ में सिर्फ कर्म करना है. तो वी शुड डू गुड थिंग एंड कीप रिजल्ट्स in God's hand. Sir, option trading is mere speculation. No, it is not a mere speculation. It is basically a hedging tool. It was constructed only for hedging. Like, I can give you a small example for option trading, whether it is not at all a speculation. Because if we buy a new car, can you take car out of your showroom without any insurance? You cannot. So option is also a insurance. to underlying an asset, like to your equity. It is an insurance to your any equity thing, but it is without any equity, without underlying lying asset. We are doing option trading, so it is just like an insurance to your car. It is a tool to protect your car. In case of any mishappening, it will protect your capital. So it is not a speculation. It is hedging tool. But we are trading in hedging tool only. We are not taking care of original lying asset. No other question, ma'am?
No other questions, sir.
So shall we conclude?
Yes, yes, sir.
It was great interacting basically with lots of questions, and I hope I tried my level best to answer them. But in case of any difficulty, you can call me or you can WhatsApp me anytime on my mobile number.
Okay, sir. I would like to thank Sanjay sir and Sanjeev sir for the insightful session. Thank you, sir.
One more question has come. Sir, if option are for fun sake, whether it can create wealth, क्या आप technical analysis follow करते हैं? I don't follow technical analysis. I do pair trading. I do take care of mathematics only. It's not fun. It's real money involved, but it can create lot of wealth. My mobile number is very simple. You have to just remember first five digits. It's 93168 93168. I'll write 93168 93168. I am always a option learner every day. I would suggest start investing through equity. Start, trust me, and start doing that with that theory. You will always be successful.
Now there is no live question, sir. There is no new questions.
There is no new questions? I can go further for more strategies if there are people, but otherwise we can conclude as you say.
Yes, sir, we can conclude, sir.
One question is there now. What about strategy suggested by CS and Singhania of Z Venus? If you follow him, follow him. If it suits you, go for it. Before applying any strategy, there are lot many software and things are also there on the Google where you can backtest your strategy before applying them, and you can backtest your strategies for more than 2 years back with 2 year data available on the screen. You can backtest your strategy, then apply these strategies, any strategy whichever you like. I haven't listened your views on AI shares. AI means
Artificial intelligence.
Why artificial? CAs are natural intelligence. Why go for artificial? Go for your mind, select your sector, select the best share, and go for it with the SIP. This is AI shares means which comes under the sector of IT. So IT, you can have under the sector IT any of your AI shares. Sir, many people are taking paid calls. Please enlighten on this into our community. Paid call means paid calls. What does it mean? Please explain. Can we buy a sectoral mutual fund? Question is, sir, mutual fund, I give you an example. If you, I am very good in playing cards, right? and on Diwali days I regularly play cards. If you know how to play cards, why you will give your cards to some other person to play? Why he will take the maja? If I know how to play the cards, I will play my cards with my own. I'll exit, I'll enter with my own sweet will. Why I will give my own cards to some other person? Mutual fund is like that. You are giving your cards, you're giving your money to some other person to play with, to to be happy with it. Why I will give my money to some other person? I'll enjoy with my money. I will play cards with my own money and daily experience new things and learn and put it into strategy and make it right. Mutual fund is for those people who don't know how to play the cards. You can go for Tata Elxsi definitely, but you have to skip Infosys or TCS for that because you have to keep only one share in one sector. If you have got 20 lakh rupees, if you have got 40 lakhs, then go for Tata Elxsi and Infosys also. More questions are coming.
A paid suggestion on positions to take, especially in options, from a fake expert or a group of individuals.
इसमें तो you are will any of your client will go to chartered accountant for his suggestions or any accountant? Which will you prefer? Who he client will always go to the best one, like CAs, to take his designs or for suggestions. Why we will go to fake people for suggestions? When we one should never go for paid. Agar itna hi they would have known the market, why they will give suggestion to others? Why won't they earn by themselves? Never go for it. Start with small quantity, learn it, but don't go for paid ones. I won't suggest it. Or go for the best ones. Or go to the best who maintains the PMS, portfolio management service, who gives. Go to them. But don't go to this. Whether you will suggest any of your client to go to any accountant other than you. Sir, I watch business channel only for news purpose. And they do some good jokes also. Business channel. Keep you happy in your bad times also. Any other questions coming?
No questions, sir.
Yes, sir. Experts on TV do not do trading and they are giving calls. Sir, last, I think 2-3 months back, some news reporter was also caught. He was selling his shares and giving to buy the shares on the channels. Then he was caught through SEBI artificial intelligence and he was thrown out of the channel. So you cannot, even I know some people coming on the TV which give calls to their, because they are from some broker, they give to calls to their clients first, Then after 10-15 minutes, they give 2 calls on the TV. Why trust anybody? I think after doing SIP, you don't need any suggestions from anybody. Rather, you will start giving suggestion to others and charging for it. There are many Telegram channels, WhatsApp groups run by these fake experts in the market. Many are taking those services. No, that's why they make losses and tell share market is a jua. It is in fact not a jua. When they lose money, they always spread share market is a jua because of these people. It is the best source of income nowadays. Only single person can do share trading without any involving anybody, without taking any extra expenses. Only you need is a laptop or mobile and good internet connection. These WhatsApp group and Telegram channels are just like Panditji. When our time is not good, we go with them. He tell our future. Any more questions coming, ma'am?
No more questions, sir.
I hope everybody listened to my webinar and got something out of it. I'll be highly happy in case you apply also and make a lot of money.
It's very interesting, sir. It's very interesting sessions.
Yeah, very interesting perspective, and really appreciate you sharing your knowledge, embedded with your past experience.
Geeta ma'am, you can conclude.
I would like to thank Sanjay sir and Sanjeev sir for the very insightful session. Thank you once again, sir.
Thanks a lot for the opportunity and for the institute to provide the platform for us to be able to impart some learning which we have learned over the years.
Same here. I also thank to Institute for giving us opportunity to share our experience with the audience. Whatever we have experienced, we try to tell you, and everybody should have enjoyed it and make it in their real life investing.
Thank you, sir. Thank you very much. Sanjay sir and Sanjay sir, both are very good, sir. It's very dedicated sessions are conducted, sir. Thank you very much. Geeta ma'am, thank you very much.
Thank you.
Thank you, sir. Good night, sir.
Good
Thank
night.
you. Good night, and everybody have a great weekend. Thank you.
Thank you, sir. Thank you. Thank you. Good night, sir.
Recording stopped.